Well, a very interesting note coming in from Sanjay Mookim from JP Morgan, and what they have actually analyzed is they've analyzed the credit growth for financial institutions in the country. It's a significant development according to them that post lifting of the lockdown, they see that banks should see significant credit offtake. They also believe that going forward, financials can outperform equity markets within the entire space. Now, number one, what they have done, they are expecting that given the fact that we are currently enjoying a strong monetary stimulus, they believe that this should drive lending growth higher post the lockdown. Also, what they're saying that Indian banks should actually perform quite well relative to the market if that really manifests itself. In this context, their top picks are within the Indian financial space, ICICI Bank, HDFC Bank, as well as SBI. However, one of the worries, according to JP Morgan, is the fact that equity markets, especially NIFTY, which is trading near its lifetime highs, are currently valued at very high levels. The NIFTY currently is trading at 21 times 1 year forward price to earnings as per the JP Morgan estimates, and they believe that this is something that the NIFTY is actually pricing in a 50% EPS growth over the next 12 months. What they're saying is that this particular rally has been fueled by global liquidity, and they believe that this is why most of the stocks and sectors currently are very, very expensive. Incremental investing within the equity markets must assume that global valuation support sustains at these levels, and then they must try to follow business as well as operational improvements. So they're saying going forward, investing in the markets, investing in equities will remain quite tricky. Also, what they're saying is that banks should remain key picks going forward as well. Now, one of the worries, according to them, is the fact that bottom-up signs of specific lending constraints are existing. They believe that deposit growth has remained in the low double digits for quite some time, even as deposit rates have fallen sharply. SBI's 1 year fixed deposit rate is now at a 50-year low. And also what they're saying is that a variance analysis of bank lending suggests that the slowdown between 2017 and now can largely be attributed to weaker credit growth. Also, what they're saying is that weaker credit to NBFCs, housing, as well as large rates for PSU banks are at this point of time much below what it is for private banks. Now, also what they're saying is that PSU banks have largely lent to housing, personal finance, agriculture, and trade through 2020. These bottom-up measures suggest that there are specific near-term constraints to lending which can be released once the country exits the pandemic. So overall, we are waiting for credit growth, credit offtake to pick up meaningfully once there's the lifting of the lockdown.